Hello and welcome to FidelityConnects. I'm Glenn Davidson. U.S. small caps are back in the spotlight, outperforming large caps by more than 8 percentage points so far this year as market leadership begins to shift. That surge is being driven by rotation away from mega cap tech, stronger earnings momentum, and small caps' heavier exposure to cyclical sectors like regional banks and the U.S. domestic economy, raising a bigger question about what this moment means for investors. And our guest today says the real story isn't just performance, it's how disciplined research, perspective, and decision-making matter most when markets are this fluid. How do portfolio managers operate when headlines change by the hour? Does volatility alter research priorities? And where do small caps fit as a complement in today's portfolios? Joining me now to unpack all this and more is Steve MacMillan, portfolio manager of the Small Cap America Fund and director of research. Steve, welcome. Great to have you here.
Thanks. Great to be here.
We're going to talk about Small Cap America for about half of this webcast, and then we'll talk about your role as director of research and really the growth of the research team as well. I think that'll be fascinating. But first, Small Cap America. 1994, the fund started, but you haven't been running it since 1994. You've been running it for 15 years next month, I believe.
Yeah, coming up.
Congratulations on 15 years. It's
Thank
amazing.
you.
I remember when it was taken over by you, and it just seems like yesterday, so that's really amazing. Why don't we start with what your style is all about? Just a reminder to our viewers.
Sure. Ultimately, what I'm trying to do is find businesses that generate a lot of cash flow, that are very stable and recurring. They're going to have more money 5 years from now than they have today. And I'm trying to bring a scary asset class, small cap stocks, and package it in a risk budget that most Canadian retail investors can digest. And if you look over the last 15 years, the fund performance has been very strong over a long period of time. The fund's much higher than it was 15 years ago today. But the path from there to here has been much smoother than a lot of areas of the small cap market that allows investors to come along for that ride.
You said scary asset class. Is that because of the economic sensitivity of small caps typically?
You know, if you were to just say buy the index and you were just to broadly look at the category, think about almost half of the stocks in the market don't actually make money. And so they're typically further out on the risk spectrum. If you think about, though, small caps from a Canadian context, you're getting down into stocks on the TSX Venture and very small microcap stocks. Whereas if you look at the Small Cap America Fund, you're looking at companies that are more at the bottom end of, say, the TSX 60 from a market cap standpoint. And you can find businesses that dominate the niche that they're in, that have $1 billion worth of revenue, but are very focused, but they're generally great cash flowing businesses. And those are the kind of areas that I look for. And I tend to shy away from really those businesses that are more on that speculative end, which really have been quite popular of late in the market. And I think for investors looking to have a little bit more certainty, looking to avoid some of those speculative areas in the market, the fund offers a lot of diversification, both from the Canadian market, but also the large cap market right now.
And you're typically in the 60 to 70 stock range in the portfolio, is that right?
Yeah, historically 40 or 50. I've crept up a bit higher more recently. You mentioned that I've been on the fund for about 15 years now, which is hard to believe. But there's things about now that remind me a lot about 2011. When I first took the fund over, you might remember some of the conversations I was having with our advisor clients. And in 2011, the popularity of Canadian equities was really at its peak. And US equities was a dirty word. If you looked at the previous 10 to 15 years, you had the NASDAQ crash, you had the commodity boom, you had the housing crisis, and you had a Canadian dollar that troughed at 60 cents and made all its way above par. So every dollar you'd put in the US market up to then had been a waste. And the comment at the time was we should be looking forward and not back, and that the US market offered a lot of diversification from Canada, away from energy, away from banks. And what I see in common today is that we have a similar concentration in our investments, but it's a different one. If you look at the S&P 500 today, any global fund, they're going to be very heavily concentrated in a small number of large cap tech stocks. And more broadly, there's going to be a very high theme associated with AI, data centers. And if you look at the Small Cap America Fund, it's a low single-digit exposure to technology, large weights in consumer, industrials, financials. I believe there's a place in a portfolio for someone that wants to own a water utility, that wants to own an education company, that wants to own a funeral home company, that wants to own insurance stocks, banks, and they kind of want to take a step back from the discussion and the narrative of whose chip's going to be the fastest, whose model's going to be the best, is it going to take over the world, and just say, I want cash flow.
Yeah. It's a refreshing mindset, isn't it, to be away from what the news is so focused on today. You talked about what's happened since 2011 when you took over the portfolio. And when you think about what happened since you became an analyst at Fidelity, or even your previous career in the industry, you've got a lot of, for lack of a better word, we all do, battle scars as far as this marketplace. And I want to resurrect that as a question when we're talking about you managing the research team, because that's got to be an amazing help to people who are newer to the industry. So we'll come back to that. But how did you get more of a value approach to your style?
I think we're all products of our upbringing. And if I think about my analyst team right now, if you've been in the market for 3 to 10 years, the only thing you've seen outperform is growth stocks. You've seen expensive stocks get more expensive. Earnings momentum has been the main driver. If I look back to the start of my career, it was in the late 1999. And then stocks went down every day for the next 4 years. And it just got me very focused on downside protection.
Okay.
I think also there's a strong personal element to my own personality that tends to focus on risk and the downside. And that hasn't prevented the fund from doing very well over a long period of time. There's a difference between being risk aware and risk averse.
Well, there's always a sleeve for that in a portfolio, isn't there?
Yeah, absolutely.
Let's talk about for lack of a better word, the chaos in the market today. There was a quote in the Wall Street Journal that said, "For anyone who believes that the stock market is totally rational, the past 7 weeks have provided an expensive education." How do you summarize for us what's going on in the market today as a portfolio manager?
Yeah, I think you have a lot of uncertainty in different areas of the market. And so I think if you look at areas like technology, AI, when people feel good and they're not worried about tomorrow, and they look at a very wide range of outcomes that could happen, they're more willing to bet on the high end of that range of outcomes. When they start to be concerned about their portfolios, their retirement, they're thinking about their investing, and start to think more about the downside, they're less willing to underwrite the best case scenario, and they start to think about the worst. And so if I think about the last 2 weeks on the market, since we bottomed around March 30th, has the chance of AI taking over the world greatly increased? No. There's been no material change in technology over the last 2 weeks that I'm aware of.
Sure.
But if you look at the Russell 2000 small cap index and the largest stocks in the index, there's a number of them that are up 60, 70% in 2 weeks. All AI related. And it's just that people have become more risk seeking. And I think it's really important to recognize that can turn very quickly as well. And so I try to have a longer term view, have lower turnover, and try to find those businesses that can compound regardless of what's happening in this area of the world.
Try and stay away from the noisy themes.
Yeah.
And so what's happening in the Middle East isn't swaying your portfolio?
No, I think there's always going to be tangential impacts. For me, when I look at the portfolio, most of it I think is relatively removed. If you look historically, there have been very few wars that have impacted the U.S. stock market. And if I look at today, I would say the biggest risk would be just higher oil prices and the impact on the consumer and inflation. And so the impact I would see would be more around consumer stocks. You have consumers deciding between filling up their gas tank or going out to a restaurant. I think these are manageable. I'm viewing the current supply shock as being temporary because I think you have two sides that both need and want the oil to flow. I think my personal opinion is that Trump might be regretting this war. He hasn't accomplished anything that I can tell.
Sure.
And so, I'm expecting that they'll find a way to back out of it.
So fair to say, too, it creates a lot of opportunity because, as you said, that there is collateral issues sometimes from this sort of thing, and it creates opportunity for a portfolio manager because you've got your models, you've got price points that you're looking for, and that can create some excitement as well. Does it change your day-to-day as far as the frequency of information versus when you were starting Small Cap America, 15 years ago?
I think that there's been a lot of noise and information my whole career. It hasn't gone down. It likely never will. And so I think for me, it's really about what we like to call time horizon arbitrage. The average stock and the New York Stock Exchange changes hands, I think, about once a month, based on the the level of trading and turnover. I try to think about owning stocks for several years, and that creates opportunities. And so if someone's selling a great business because oil's gone over $100, I can think about this on a 5-year view and try to own it through it. And so it does create opportunities. One of the things I'm always telling the analyst team is to be very aware of what's going on in the macro. Don't let it drive your decisions, and try to think about that 3 and 5+ year time horizon of the business model, the earnings power, and where the stock's going to be over time.
I've known you a long time, and what I've always found very interesting about what you talk about and your style for your portfolio is that you do look for those inputs. For instance, you were saying about AI is a massive theme, but not for you. There's lots of building blocks that can support a data center, as an example. I went on a tour of a large online retailer's fulfillment center last week. 1 million square feet, 5,000 employees, lots of technology, but lots of inputs. And I actually thought of you because I knew we were doing this. When it comes to conveyor belts, when it comes to lights, fans, just mechanics of a large structure, because I remember in the past you used to talk about ceiling tiles even. There's a lot of logic to that. And there's also a lot of logic to what you've pursued with respect to consumer discretionary, but also non-discretionary, things that we can't control, but we need. Can you talk about some themes? Why don't we start with that support for, say, data centers, the inputs. You still believe in a lot of these pieces that need to be supplied for these data centers.
Yeah, I think you're going to see a lot. You've already seen a lot of small cap companies benefit from these themes. I like to say that they're eating the crumbs of giants. And I think the challenge becomes the valuation some of them have gotten to.
Meaning that value stock may have been leaning to a growth stock now.
Yeah, and I think you then go from growth to value to growth to speculative.
Okay.
And so, one of the things I'm trying to do is look at companies that you wouldn't think are going to be big beneficiaries of AI. Regional banks, as an example, insurance companies.
Okay.
These are going to be the implementers of it. And I think what you could see is margins improving. I also, when I'm thinking about what is, quote, safe from AI, I think one thing that can't be replaced by AI is capital. And so if you look at the portfolio, there's a large portion of it that's invested in financials, whether that be banks, insurance companies. And I think that capital availability is really important. You can't use AI to insure against a hurricane loss on your house. And so having those companies that have a high ROE, that are trading close to book value, that are probably going to have cost savings from implementing AI, helping their margins and their returns. I think these are going to be the businesses that the market is eventually going to shift their focus to of, okay, we have the companies that have discovered the AI, now let's find the companies that are implementing it to make their businesses better on a day-to-day basis.
So that's interesting. You don't want to look for a company that's a value stock today that seems under the radar that could become speculative in short order, because that completely changes the thesis and the build of your portfolio. But
I'm happy to sell a stock that's gone from value to speculative,
right.
But I'm probably not looking to buy it once it's already there.
And you also have a keen eye on risk, and so you don't want a lot of that in the portfolio. Yeah. But yeah, selling them at the right time makes a lot of sense. But you are looking for the companies like financials, as you said, who are the supplier of capital to the companies that are really involved in all of this. Other sectors that we should talk about, perhaps consumer discretionary.
Yeah, we have a lot of great consumer discretionary stocks in the portfolio, a mix of very stable businesses, like we mentioned, the funeral home cemetery sector that I've been in for a long time, some education stocks, but also some growthier restaurant companies, some consumer product goods companies. And these are more looking at individual bottom-up business models that I think are really good and that are going to succeed over time. And really just looking for businesses that are going to do well regardless of the economy, that have a secular growth theme behind them, that are trading at attractive valuations. And when I look at the Small Cap America fund generally and its role in a portfolio, I just think about its ability to complement those large cap tech companies that maybe people are overexposed to.
Makes a lot of sense. What about industrials?
Really, what I'm trying to do with industrials, the same way that I think that capital can't be disintermediated or replaced by AI, I think things like machinery and physical goods can't be disintermediated either. And so if I look at the portfolio, I have a decent amount of exposure to agriculture right now, agricultural machinery. I think we're going to have an ag cycle. I also think that if you believe that the economy is going to be strong, there's several areas of the market that are still depressed, like agriculture, that I think are due for an upswing. I think my base assumption in the economy is that we are going to ride through this current weaker patch, and that we'll have a stronger 2027, and that we'll be positioned for it.
Agriculture's been impacted, no doubt, from the backlog of fertilizer in the Strait of Hormuz. What do you see as far as ramifications there?
Ultimately, I think farmers are still going to use the fertilizer because of the yield impact, and I think ultimately it results in higher prices to the consumer side, and I think ultimately it gets passed through.
Consumer staples, your thoughts?
Staples are a tricky spot. It's actually more of a large cap sector. There's not a lot of small cap brands, because typically when you have small cap companies that have a higher growth, they typically get bought out by one of the larger CPG companies. The other thing that's challenged right now is that if you look at packaged foods companies, the way people are eating is changing, and a lot of them are more of the kind of the center of the grocery store, center aisle. And so they've got input cost inflation right now at the same time that you have weak demand. GLP-1s is also an impact on demand, but generally how people are eating is changing. And so some of these businesses that were tremendous stocks for 40 years have really seen their multiples compress over the last 10 years as earnings growth has really fallen off, as organic growth has really turned negative.
The prospectus for your fund says you can be small and mid-cap.
Yeah.
Is there a point where can you carry a stock? I know you'd be happy that a small cap stock turns into large cap and you sell it before it becomes speculative, but do you have to remove them from the portfolio?
No, if you look back, I have had stocks that were in the portfolio from the day I took it over until very recently, and that went from small cap to large cap. And so you have that wiggle room to keep it in the portfolio. I try to only invest in stocks that are more or less kind of $10 billion and under to keep kind of true to that mandate. And there's so many opportunities there that I don't need to go out and find those large caps to buy on day one.
I do want to ask you about another sector, and that is information technology, around 6% in your portfolio. It's interesting that you have it in there, but could you tell us about your thesis behind those information technology stocks relative to the market?
Yeah. Well, if I look back about 2 years ago, we had a new analyst come onto the fund, or come onto the team. As a director of research, I assigned him to the technology sector. He was going to be covering a lot of software companies. And at the time, the message he was getting is, you're getting a chance to cover some of the best companies in the world. Software is a bulletproof business, it's recurring, high gross margin, low capital intensity, all these great things. And it's been a total disaster of a sector. Small cap software. He
was a good hire, though.
He's great.
Great.
He's great. Small cap software has been going at the gravitational speed towards zero. And its issue is really, it's an AI loser. There's so many risks around AI being able to code. creating an increase in software availability and lowering the barriers to entry. And really, it's, I think, exposing a bigger issue, which is that they never made any money to begin with. And so there's a small number of really great large cap software companies that have very high margins and generate a ton of cash flow, and then a very long tail of companies that promise they're going to get there someday, and very few that ever did. And so now you have a sector that is not making money today, that is at risk of not being around tomorrow. And so those stocks have been under tremendous pressure. They're a large weight in the index, and I'm not invested in them really at all. And so I've been avoiding that space, which has been a good decision. The other part of small cap technology is typically hardware, which historically have actually been very bad businesses that have high capital intensity, high cyclicality, and low barriers to entry. Today, though, they're benefiting from this AI data center spend, and they've become growth stocks. And so you've seen areas of the market where you've had very speculative rallies in these stocks, driven by very strong earnings. And the question now is how long these companies can sustain those earnings for. And so broadly speaking, in small cap tech right now, I think you have a wide swath of what you would call AI losers that I'm avoiding. And then on the other side of it is AI winners whose valuations have become quite speculative that I don't really think fit the mandate well.
Good. I'd like to shift to talk about your Director of Research role, but before we do, I just want to sum up what you already summed up, which is the case for small cap America in a portfolio. You are looking for those inputs to AI in many cases and inputs to life. And it's a great alternative to the focus that people have had on large cap, growth, similar names, etc. There's a real merit to having a sleeve in a portfolio in small cap America, as you were saying. Director of Research, can you talk about the size and scale of the team that you're responsible for?
Yeah, sure, absolutely. So Fidelity is a big place. And so if you look at Fidelity International, which is based out of London, we have about 160 analysts globally. If you look at FMR, which is based out of Boston, you know, Will Danoff, Mark Schmale, et cetera. I think they're well over 100 analysts, probably similar. And here in Toronto, of that, we have about 25 analysts, which myself and Ritu Kumra focus on the equity side. And you know that team continues to grow. And you know we've got 6 bright-eyed interns ready to start in a few weeks, and we're looking to grow the team. And you know we continue to add our research coverage, especially on the small and mid-cap space.
Beyond 15 years ago, you were an analyst. When you think about your day-to-day then and a day-to-day of an analyst today, with AI as a tool, can you talk about how it's different?
Yeah, that's it's really timely. I actually just sent a message out to the team this week saying, let's talk about how you're going to be using AI this next earnings season. How can we use it to be more efficient? How can we turn over more stones? How can we get these earnings notes written faster? And it was great just seeing all the teams sharing their best practices of how they're using it. And you know, my conclusion to the team was, you should absolutely be using AI to convey information, and you provide the insight. And so I think generally speaking, what AI does a really good job of is delivering facts. What it doesn't necessarily do a great job of yet is providing opinions and providing guidance, advice, et cetera. And that's really where the judgment of an investment professional comes in.
That makes a lot of sense. Don't trust the thought. Trust really the aggregation of information and the speed with which you can get it, but don't rely on it to make the decisions for you.
Yeah, so what we can do if we have a company reporting, we can put in the model, these are my estimates for revenue, margins, earnings, guidance. And then when earnings come out, you can ask very quickly, how did it perform relative to my estimates, and very quickly get a itemized list of how it did, what are the key concerns in the quarter, and then you can put your own overlay on it of what your opinion is about the future, because ultimately AI is about more the past, and we're not in the yesterday business, we're in the tomorrow business.
As we talked about at the outset of this webcast, there's a lot that you've been through as a portfolio manager and an analyst as far as all the bumps in the road in the marketplace, the volatility and catastrophes that get ironed out and so on. How do you convey your learnings on that to the analyst team that you're working with today who haven't seen that side of the market?
Yeah, for me, there's a lot of unsolicited advice that I'm always giving the team. Generally speaking, I'm trying to tell them to take a deep breath and don't make avoidable mistakes that are more behavioral than analytical. So don't let the fact a stock is down make you think it's a sell. Don't have a stock that's up make you think it's a buy. Try to take that objective step back and look at what's going on in the market, ride through volatility. And I always try to remind them that the market changes, and just because it's the way it is today doesn't mean it's going to be that way tomorrow. And so if I look back to when I was brand new and one of those interns stepping into the industry in 1999, the only thing that outperformed were the largest stocks in the market. It was a very large cap market. It was a growth market. And then for the next 3 years, you had the S&P 500 falling, but the Russell 2000 actually rising. And I think if we look at where we are today, very different markets. AI is not the dot-com bubble. These are real businesses that are generating real cash flow. But you could very well have a rotation where you have multiple compression in some of the largest stocks in the market. If you do have technology underperforming, then you can have an opportunity for regional banks, industrial companies, small cap consumer to outperform and grind out those higher returns as people seek cash flow and certainty and maybe want to step away from the AI trade.
Which will be a very exciting time for you. Company access. The research analysts are going to see companies all the time. There's conferences, but they're going and doing individual meetings. I hope this is a fair question, but is there a consensus that you're seeing through the research analysts, through different sectors on the labor market, just overall economic, the vibe of the economy and so on? Are you getting any sense that you can aggregate?
Yeah, I mean, it's a constant flow of information that we're trying to really distill into themes. I think we've heard a lot about the K-shaped economy, where the lowest cohorts are doing poorly and the highest are doing well economically. I think you see that across our research, across the companies. I think key themes right now that keep coming up are things like tariffs, input costs. I think we could have some negative surprises in first quarter earnings, around second quarter guidance, around some of these input costs and demand. And I think it's going to be up to the broader economy and whether or not this continues or whether or not it is a kind of a shorter term blip.
An amazing amount of uncertainty for people running companies. Yeah. But your team's on it. The competitive advantage would be the size, but also the ability to do whatever they need to do within the limits of rules and regulations, of course, to get the best results for unit holders. Is that a fair statement?
Yeah, we ask them to go out there and find the information, and they have a wide swath of opportunity to go out and talk to the experts, talk to companies. Because you have the name Fidelity on your card, people are willing to talk to you. And so that gives us the ability to have this huge network internally that you can rely on, as well as the access to the people outside of the company. And so when I talk to our young associates, the young analysts that are coming on the team, one of the things that I always tell them is the biggest resource you have is the portfolio managers and the senior analysts that have maybe covered your sector before and have the expertise. And the thing I always tell them is being an analyst at Fidelity is an open book test. You don't have to do this on your own. And the more you use your resources, the better you're going to do.
That's a great conclusion. Thanks very much, Steve. Very interesting talking to you today.
Thanks, Glenn. It was great.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.